Welcome to the deep dive. Today we're getting into one of the most, let's call it contradictory earnings calls of the season. We are doing a deep dive on SentinelOne, ticker S, and their fiscal Q3 2026 results. And this quarter, it really feels like a turning point for the company.
It really does. Because you had management on the call basically declaring victory.
A total victory lap. They were talking sustained profitability, huge revenue milestones, incredible financial discipline.
And yet, despite hitting all these targets, the market's reaction was, well, it was swift and it was brutal. The stock just got hammered.
So that's our mission today. We need to figure out this conflict. We'll unpack the financial wins that management was so proud of. We'll look at the AI strategy. And then, crucially, we have to find out what spooked investors.
Right, what caused that massive share price drop when the numbers look so good on the surface?
Exactly. Why did success lead to such a big sell-off?
It's a classic study in market expectations.
Yeah.
It all starts with the headline numbers. And if you just look at the print, it was a clean double beat, top and bottom line.
And not just a beat. That bottom line number was a big surprise. Non-GAAP EPS came in at 7 cents. The consensus was, what, 5 cents?
5 cents. So that's a 40% upside surprise.
Yeah.
I mean, for a company that was burning cash not too long ago, that is a powerful signal of maturity.
And what about the top line?
Also solid. They reported $258.9 million in revenue, which beat the street's consensus of $256.2 million. So you're looking at 23% year-over-year growth. Any investor just focused on the quarter that just happened should have been thrilled.
Should have been. And there's the paradox. Because they weren't, the stock immediately dropped over 7% in after-hours trading.
And it got worse from there. By the time the market closed the next day, that caution had turned into a full-blown rout. The stock was down over 14%.
So the takeaway for you right off the bat is that a great quarter looking backwards just doesn't matter as much if the market sniffs out any weakness looking forwards.
Precisely. It was a bullish print, fundamentally. But the market was obsessed with these subtle hints of deceleration that were kind of buried in the guidance.
Okay, so let's dig into the good stuff first. Let's look at those milestones that management was building their whole narrative on, this idea of sustained profitability. What were the big achievements?
Well, they delivered. I mean, they absolutely delivered on the financials. The big one, symbolically, was annual recurring revenue, or ARR, crossing the $1 billion line.
The billion-dollar club.
Exactly. They hit $1,055 million. That's up 23% year over year, which is still very strong at that scale. And net new ARR was also healthy at $54 million.
In that ARR growth, it suggests they're not just signing new customers, but they're getting bigger deals and keeping the ones they have.
It does, and the other metrics back that up. They now have 1,572 customers paying them over $100,000 a year. That's a 20% jump.
And that's your enterprise momentum right there.
It is. But what really stood out to me was the RPO growth, remaining performance obligations.
Right. And for anyone who doesn't live and breathe these reports, RPO is basically contracted future revenue. It's the money that's already been signed for, but just hasn't been booked yet.
Couldn't have said it better. And their RPO grew 35% to $1.3 billion. That's your proof of longer-term commitments, bigger multi-year deals.
Okay, so the top line is solid. The customer base is growing. But the real story, the thing they've been working towards for ages, was the margin inflection.
This is it. This is the moment they proved the business model can actually be profitable. So non-GAAP gross margin, still elite at 79%. But the magic happened further down. Non-GAAP operating margin swung positive.
To what?
To plus 7%. Positive 7.
Wow. And where was it a year ago?
A year ago, it was negative 5%. So you're talking about a nearly 1,200 basis point improvement year over year.
That is a staggering turnaround. What does that tell you?
It tells you they've completely changed how they spend money. They found efficiencies. They've reached a scale where they're not just burning cash to grow anymore, and that flows right through the rest of the P&L. Non-GAAP net income margin hit positive 10%.
And I'm guessing that means cash flow turned positive as well?
It did. Operating cash flow margin was 8%, and the big one, free cash flow margin, was 6%. This is the inflection point. They are now officially generating cash every quarter, sustainably. They don't need to raise capital to fund the business anymore.
So an incredible financial report card. But that's only half the story, right? We need to look at the product engine behind it. The CEO kept talking about leading in both AI for security and security for AI. What's actually driving that?
Well, the proof is in the bookings. And one number really jumped out, non-endpoint solutions. So everything but their original core product, made up about half of their quarterly bookings.
Half. Okay, so they're not just an endpoint company anymore. That's a real diversification.
It's a reality now, not just a promise.
Yeah.
And the biggest driver of that seems to be Purple AI. That's their security co-pilot.
And how's that doing?
It achieved a record attach rate. Over 40% of licenses sold in the quarter included Purple AI. So for you listening, that means nearly half their customers are buying into this idea that AI needs to be at the core of their security stack.
And it's not just the co-pilot. They're seeing growth in data security, too.
Oh, absolutely. Their AI SIEM and data solutions saw triple-digit bookings growth, and they're winning big deals. They mentioned one where they replace a huge legacy Splunk deployment at a global hospitality brand.
That's a major competitive win. Taking on Splunk is no small feat.
It's a huge scalp, and it's directly related to a strategic acquisition they made, the Observo AI deal.
Right, I saw that. What was the thinking there?
It's all about owning the pipeline. Observo AI gives them control over the infrastructure that ingests and routes all that security data. Management thinks if you own the data highway, you can make your AI analysis faster and, frankly, a lot cheaper to run.
We also saw them push into Gen AI governance with prompt security and a new managed service called Wayfinder.
Yes, all part of building out this broader platform. And it's working. They're using it to land these big, multi-year, multi-solution deals. They cited a 5-year CNAPP deal with a global consumer products company.
Okay, so let's stop there. We have a company that just hit profitability, crossed $1 billion in ARR, is expanding margins like crazy, and has real AI product momentum. Which brings us back to the big question.
Why on earth did the stock collapse?
Exactly. The market saw all of that and decided the future looked worse than the past.
And that's the conflict. Because the number one reason cited everywhere was the forward guidance. It was just a little soft.
How soft are we talking?
They forecasted Q4 revenue of $271 million. The street was looking for $273.1 million.
Wait, that's it. A $2 million miss on a $270 million quarter. That's what caused a 14% drop.
Welcome to the world of high-growth tech investing. It's not about the $2 million. It's about what it implies. Q3 growth was 23%. That Q4 guide implies growth is slowing to about 20%. And any hint of deceleration, even a few points, gets punished.
So the market reads that as them losing ground to competitors like CrowdStrike or Palo Alto network.
That's the fear, and it was compounded by a complete surprise on the leadership front.
The CFO?
Yes. The announcement that CFO Barbara Larson is leaving in mid-January. You have to understand, she was the architect of this whole profitability push. She's the one who delivered that 1,200 basis point margin swing.
So her leaving right at this critical moment creates a ton of uncertainty. It's major key person risk.
It's the worst possible timing. It makes investors question if that new financial discipline is permanent or if it was just tied to her. And having the chief growth officer step in as interim, it just adds to the question.
Okay, before we get to the trade idea here, we have to do the thing. You know the drill.
Yes. This deep dive is for informational purposes only. It is not and should not be taken as personal financial advice. You have to do your own homework.
All right. With that out of the way, given this massive sell-off, this disconnect between Q3 performance and the market's reaction, what does the data tell us about what the smart money was doing?
So the whole thesis here is that the market just overreacted. A 14% drop for a tiny guidance miss and a temporary leadership change feels excessive, especially now that the company has positive free cash flow. There's a real financial floor here that didn't exist a year ago.
A floor that big institutions would probably want to buy at?
And the options data suggests they did. On the day of the drop, options volume was 177% of the daily average. And we saw flags for over $1.8 million in notional value going into bullish-leaning trades, even while the stock price was tanking.
So big money was using the panic to build a position.
It looks that way. They're betting the sell-off was an overcorrection.
So what's the outrageous but plausible pitch for someone who believes that profitability story is the real story?
The play is basically a bet against that panic. It's a wager that the Q4 guide was just management being conservative, and that the new profitability floor will stabilize the stock faster than people think. So the pitch is something like a synthetic long position.
It's selling puts.
Exactly. Selling some near-term, out-of-the-money puts, you're basically getting paid to agree to buy the stock at an even lower price, betting that the technical floor, supported by that smart money, is going to hold.
It's a fascinating thesis. You're betting that the margin stability will eventually win out over these short-term growth fears. The catalyst would be a clean Q4 and a solid new CFO hire.
That's the whole trade.
Okay, so to wrap this all up, SentinelOne delivered a landmark quarter. They hit their profitability goals, smashed margin targets, crossed $1 billion in ARR.
But the market looked past all of that, focusing instead on slightly slower growth ahead and the surprise departure of their CFO.
The things that should really stick with you are that massive swing to a positive 7% operating margin, that 40% attach rate on Purple AI, and the strategic purchase of Observo AI.
The company has proven the model works. They can be profitable. That chapter is, for now, written.
Which means the focus has to shift back to growth.
Right. The next chapter isn't about profit. It's about re-accelerating. Can this new platform strategy, with half their bookings coming from non-endpoint products, deliver the kind of growth the market demands when they're fighting giants like CrowdStrike and Palo Alto, who are also all in on AI and data?
And that is the question you should be thinking about for the next few months. A perfect place to leave it. Thank you for joining us for the deep dive, and we hope this helps you make sense of SentinelOne's very complicated but very important quarter.